Earned versus unearned income. What is the difference? Earned income is income that you've actually went out and earned. It can be form of wages, salaries, your own business, or cash payments. It also includes workers' compensation and combat pay. Usually, all income is taxable, but there are certain situations it may be tax-free. Workman's compensation is not taxed, and combat pay is not taxed. Your W-2 reports your salary and your income. 1099 miscellaneous is for your contract self-employment labor. Your combat pay has a special, I'm trying to find the word, a special bonus sometimes. Your combat pay is the pay you receive while in an active combat area. You receive combat pay, you don't have to pay taxes on it. You don't have to put it on your return, but it might be helpful to put it on that return. Say you made $5,000 regular pay and $10,000 in combat pay. You have a couple of children, you're married. You'll qualify for EIC at $5,000, but you won't get much. If you add that combat pay in and make it $15,000, you would get more earned income credit. Next, we're going to talk about unearned income. This is income from sources such as banks and insurance companies, money that you make from selling stocks, money that you're not actually out there actively earning. Also, unemployment is unearned. Retirement is considered unearned income. Money received from lawsuits, unless it's for pay medical bills or lost wages, then it's not taxed. But any other money from lawsuits is unearned. Sale of stocks, as I said before, is unearned. Generally, all is taxable just like earned income. There are exceptions. Certain interests on bonds like municipal and state bonds are not taxable. Savings bonds that actually used for education are not taxable. Next, I'm going to show you some forms. A W-2 form is something you will see a lot during the tax season. These are taxable wages. Now, if they have non-taxable combat pay, it will be in box 14. The next one is the 1099 miscellaneous. This is for your self-employed people. Now, just because they say they're self-employed don't mean they will have a 1099 miscellaneous. Some just receive cash and they never receive this form. In that instance, you'll want them to write down everything they brought in for the year's income and all their expenses and have them sign it so you can keep a record of it. Next is unemployment. 1099Gs. Unemployment is unearned income. A lot of people have gotten upset. They're used to getting earned income credit and they lose their job and they go on unemployment. They make $15,000 in unemployment. They come in to file their taxes because they have to pay taxes on it. They're thinking they're going to get the earned income credit. You cannot receive earned income credit with unemployment because it's unearned income. Next is a 1099 INT. This is what you see from banks. And when you have savings bonds and stuff that gain interest, you will receive one of these statements. Next are retirements. The first form I have is a 1099-R. It is taxable. There's a certain part of it might be taxable, other parts might not be taxable. It all depends on the age of the person, how much, if they have paid in out of their wages after their wages were taxed, or if it was not taxed and put in. So when you have gross distribution, that's the whole amount they got for the year. 2A should tell you how much of it was taxable. Say we have a gentleman who started his own IRA account. He gets paid every week, taxes are withheld, and he takes part of that money and puts in his IRA. When he starts drawing it at retirement age, it will not be taxable. On the other hand, we've got a gentleman that had a 401k. Every pay period, work put in. He had him take amount out of his check and put into that 401k. But it was put in before his income was taxed, so he was not taxed on it originally. So when he starts drawing it, he's going to be taxed for it. Next is the Social Security 1099. These are for people that get Social Security retirement or Social Security disability. If the only thing they ever get is Social Security and they have no other money coming in, it's not taxable. They say they're drawing Social Security and they're drawing retirement, or somebody that's disabled and married, their spouse is employed and getting money, then part of the Social Security can be taxable. Now, a person a married filing separate return, no matter what, 85% of Social Security will be taxable. Sale of stock. Sale of stock will be reported to you on a 1099-B. In our software, you have to put it on a form like this. You're going to designate if it's the taxpayers or the spouses, what kind of stock it was. It could be 100 shares of ABC stock, the date it was bought, the date it was sold. The reason we need the date bought and the date sold is to determine if it's long-term or short-term. Short-term is held under a year, long-term for more than a year. You're going to need your sales price and your cost basis, what they originally paid for it. So, say they originally paid $5,000, they sold it for $10,000. Their cost basis is going to be $5,000 that you're going to subtract from the sales and get either a gain or a loss. Thank you for coming. Have a wonderful day.